All right, looks like we've got everybody back. So, what have we done so far? We have walked through the three financial statements: the income statement, the balance sheet, the cash flow statement. We've got an understanding of what each of those three statements are telling us, the stories that those three statements are telling us. And we also understand that the information on those statements is limited just because of the nature of the statements in terms of the information on them. So one way that we use these financial statements to give us even better information is we calculate financial ratios. Well, think about what is a ratio. A ratio is comparing one number to another number. So we're going to calculate about a dozen different financial ratios using the financial statements that we looked at before, the income statement and the balance sheet. So if you want to turn to the next page in your handout, it says My Company on it, and it has a balance sheet and an income statement. It says My Company, and there's a balance sheet and an income statement. We're going to use this information, these two financial statements, to calculate, again, about a dozen different financial ratios. And what's important as we look at these financial ratios is that you're able to understand two things. One is how to calculate the ratio, because when we're done this morning, I want you to be able to use your own financials to calculate your own ratios. So number one, how to calculate the ratios. And then secondly, and more importantly, is what is this ratio telling me? What is this particular ratio telling me about my company's financial performance? Okay. So we're going to start with, if you look to the next page, you'll see we've got profitability ratios. So we're going to start with profitability ratios. The first profitability ratio is called gross margin. And you'll see that we calculate gross margin by taking gross profit right off the income statement, in this case, $400,000. And we divide gross profit by revenue, in this case, $750,000, and we get a gross profit margin of 53.3%. Gross profit divided by revenue, 53.3%. Now, for some businesses and some industries, that would be a very good number. Like maybe a service-based business, that would be a very good number. For some industries, that'd be ridiculously high number, like a grocery store. Grocery stores' gross margins tend to be maybe 10 to 15%. So we'd want to compare this number to three other numbers to determine whether it's an acceptable or a good number or not. Number one, we'd want to compare it historically. What was it a month ago? What was it a year ago? Compare this number historically. So if our gross margin a month ago was 50%, we would say, wow, we went up almost 3 percentage points. If our gross margin a year ago was 60%, we would be concerned that why has it gone down over the past year? So number one, we're going to compare it historically. Number two, we want to compare it to what was our plan for this number? What was in our budget? And if our budgeted gross margin is 50%, we would say, well, we did pretty good. We're 3 percentage points higher than budget. If our budgeted gross margin is 55%, we would be a little concerned that we're slightly below budget. So number one, we're going to compare historically. Number two, we're going to compare it to our plan, compare it to our budget. And then number three, I want to suggest that you compare these numbers to your industry average, because it doesn't make any sense to compare your number to a number from a totally different industry, because it would vary greatly. So then the question becomes, so where would we find these industry averages? And one, your accountant should have access to industry averages. Your banker should have access to industry averages. The SBDC has access to industry averages. And if none of those work, I can guarantee you that if you go on the internet and do a search, you'll find industry averages as well. All right, so number one, compare historically. Number two, compare these ratios to your plan, to your budget. Number three, compare to an industry average.